The first meeting is really a get-to-know-you meeting. We're going to sit down. Typically, the meeting will last about an hour. We're having a conversation. My job is to ask them some questions about where they are, what some of their goals are, what some of the key objectives they have in meeting with me, where they are to this point, and really what brought them in to see me. And now I'm at the point in my career where I have a lot of people that are dependent upon me to provide them with all the guidance and all the advice that we do on a day-to-day basis.
You spend your working years trying to build up your assets, trying to build up pension credits at your job, trying to grow your nest egg so that you can one day retire when you can't work or don't want to work anymore. And that's a period followed by phase two, which is retirement. And your priorities in these two phases are very different, but many times we see people don't make that shift and they still act like they're in phase one when they really should be acting like they're in phase two.
We're going to talk to you about what we commonly refer to as the second half of the game. And what I mean by that is you're working your entire life towards retirement, and I'm assuming that most of you are, at that age where you're starting to consider some of your options as you move into retirement. And as you do that, you're moving from what we call the accumulation phase of your life, where you're accumulating your assets. Maybe you're participating in your company's 401k, maybe you're contributing to an IRA account or a Roth IRA account or some type of retirement vehicle. And now, as you retire, you're transitioning into the distribution phase, or the part where you're going to need income in retirement. So we're going to talk about some different ways to do that with an emphasis on Social Security.
Hello, everybody, and welcome to Financially Speaking with Jeff Bush. My name is Barry Warrenker, and I'll be your host. Jeff, I know we've had a lot of good information to share today, and this is going to be all about retirements and the mistakes people make with their 401ks, something that's really important if you hope to retire.
That's right, Barry. Welcome to the show. Over the years, we've helped hundreds of people enjoy a successful retirement, and over those years, we've seen just about every mistake you can make. So today's program is 9 401k mistakes to avoid.
Okay, well, this is big stuff. If you have a 401k at work, or maybe they call it a 403b or a TSA or whatever, but a retirement plan at work, this is some really important information. And the fact is, studies have shown that people spend more time planning their next vacation than they do spend planning their retirement. And since retirement is ultimately the best vacation you can have, maybe 20, 30 years of vacation, this is really a worthwhile area to discuss for folks.
That's right. So planning for retirement is really the ultimate vacation. So that's a good idea. Here's one of the most common mistakes. Mistake number one, take the money and run.
Well, okay, so you're working and maybe you just decide you need money. So that's your money in the retirement account. What's wrong with taking your own money?
Well, what's wrong with it is you are really robbing your future. These 401k accounts are tax deferral accounts, and they're really set up for retirement. They're really set up by, the IRS definition of retirement is age 59 and a half. So if you pull out that account before you're age 59 and a half, you're not only going to pay a tax on it, but you're also going to pay a 10% penalty. So you're really robbing the future for the present in that situation.
So I guess the message is, if you have other ways of handling your finances, before you go take that money from take that IRA, 401k out, look other places.
Yeah, and I think studies have shown that when people leave jobs, they generally don't roll over their 401k. They usually just cash it out and take it with them. Even like younger workers in their 20s and 30s, and that really is a huge mistake. It's very short-sighted. I mean, if you really need money that bad, you should really look at other places to take it. I mean, you should really look at that. That's sacred. That should be sacred money, retirement money.
Okay, well, let's move on to mistake number 2, and that's leaving your money in the 401k with your old employer. Now, how does that become a problem?
Well, of course you can do that. You can leave. Just because you leave your job, that doesn't mean that you have to take your money. But it is a problem because there's a control issue here, in that your current 401k may have limited options. They have what they call a plan document, which is like a very thick document that governs how this 401k plan is run. But the other important thing is that if you die, your beneficiaries will have limited choices, and like a stretch out IRA, which we've talked about before on the show, which gives your beneficiary the option of stretching out the payments of an IRA rollover over the course of their lifetime. So there's some options that make that gives you some limited choices if you keep it in the 401k. Plus, a 401k is really designed for the accumulation phase. They're really good for, accumulating money while you're working. You take money out of your paycheck, but they're really not designed for the next step, and that is, when you exit the company and you're going to need it for income, or you're going to pass it on to beneficiaries. The 401k really isn't the best vehicle for that.
So a lot of people don't realize that they leave the job, they've got that 401k sitting there, or 403b, that they have the whole wide world of IRA possibilities, which are individual retirement accounts. They can take that 401k and they can go to a whole host of custodians and have choice of thousands and thousands of opportunities to invest. They're not really giving up anything by leaving the old 401k, because they can't contribute to that old 401k if they're not there anyway. So
That's right.
so that's something they should talk to us about. If you have left the job and have it sitting over there, talk to us. We can offer you some options that you might find very attractive. So that's number 2. Number 3. We're talking about mistake number 3, which is executing a rollover instead of a direct transfer. So I know a rollover, you hear that term all the time. What's the difference here?
Well, yeah, it's just to kind of this kind of bleeds into the mistake number 2. Is that the real reason why you don't want to leave your money with the current employer is because you do have the option to do either a rollover or a direct transfer. So let's talk about that. So you have an option to move this into an IRA, and this is really kind of a paperwork issue here of how we're going to get the funds from your current employer, your former employer's 401k plan to your new IRA. So you can either do it with a rollover or a direct transfer. So the rollover is where the 401k plan, they write you a check. You take constructive receipt of the money, and now the clock starts to tick. You have 60 days to move that money into an IRA. Okay, so that presents one problem, is that, and believe me, people mess that up. You would think, oh, I have 60 days, I have plenty of time, but we see a lot of people mess that up. The other problem with that, well, there's a lot of problems with that. The IRS recently came out with a regulation that you can only do one of those a year.
Okay.
So even if you have multiple IRAs, you can only do one of these 60-day rollovers per year. So that's a problem too.
Okay.
The other problem is, from a reporting standpoint, what happens is the 401k plan has to report that transaction to the IRS, because the IRS doesn't know what you're going to do with that money once you get it. So there's nothing that says, oh yeah, I'm going to roll it over into a 401k plan. So they have to report that, and also they'll withhold taxes from that too. So,
Wow.
so let's say you have a $100,000 rollover. Well, they're only going to send you a check for 80,000, and they're going to send the other 20 to Washington.
Wow.
So that means that if you want to roll over into a new plan, you got to come up with the other $20,000 that's now sitting down in Washington as a prepayment of your taxes. So, and most people don't have $20,000 laying around to do that.
So what do you do? What's a better way to handle that?
Well, the better way to do it is to do the direct transfer. So the direct transfer makes life easy for everybody. It makes life easy for you as the consumer, because you don't take constructive receipt of the money, and it makes it easier for the new custodian, because they're simply getting a transfer check from.
So they get the whole amount. There's nothing
They
withheld
get the
by
whole amount. So it's all it's called a direct transfer, and it's just a matter of filling out the paperwork completely and correctly, and you're simply telling your 401k plan, okay, my intention is to roll over these funds to an IRA. Here's the new IRA company. Here's my account number. Send the check directly to the new custodian. You never take receipt of the money, and it's a complete tax-free. And you can do as many of those per year as you want to. And that's a little confusing to consumers, because they hear of this one per year rollover rule, and they think this is a rollover, but it's really a direct transfer.
Maybe this would be a good time if folks, if you have any questions about your 401k, IRA, those types of issues, particularly if you're considering a rollover or transfer, give us a call. We're happy to hear from you. The number's up on the board, and you can contact us shoot us an email at info@informedfamily.com. And I guess while we're at it, this might be a good time to mention that we do seminars, and we cover a lot of areas in retirement, including the 401ks and rollovers and things like that. And we hold them at local venues, which are also up in the air. If any of those are near you, it's a nice evening of try to make it entertaining as well as informative. And if you're interested in those any of those dates, just give us a call or shoot us an email requesting tickets, and we'll be happy to send them out to you. So as we move on, let's get to mistake number 4, and this is a very, very a common mistake, and made by some very, very intelligent people, and that's we call it the company stock monster, which is a little dramatic, but what are we covering here, Jeff?
Well, the issue with company stock is there's a couple issues, and we've seen some dramatic losses from people who fall in love with their company stock, and there's a couple large employers in the area, and we've talked to some people who've had a lot of money in with their company stock. So the obvious issue with that is you're overweighting your portfolio with your company stock, and it's really a risk proposition here, and it's the old adage, putting all your eggs in one basket. So years ago there was a lot of headlines, and actually subsequent to that a lot of regulation with Enron, because there's they were forcing their employees into taking their company stock as the match portion of their 401k, and of course their stock fell apart, so it rendered the 401k useless. There's a whole element of, and I'm not sure this is the show that we can cover all that, but there's a whole element of risk that's involved with how you want to manage your 401k. So there's that issue, and then there's the other problem that most people don't even realize that they even have. This is because it's kind of like a hidden nugget within the tax code, but it's called NUA, NUA stands for net unrealized appreciation, and what the NUA does is it says if you have stock in your 401k plan and there's a lot of appreciation in your stock. I mean, you may have acquired those shares over many years, and the stock may have had significant appreciation over those years. There's different ways that you can handle that other than the traditional sense of your 401k. So what you're going to want to do is if you have that situation, you want to talk to us, and you probably want to talk to your tax accountant as well, because this gets a little complicated, but there's ways that you can do this where you can get some advantages of the capital gains part of the tax code. It's really a good way to kind of take advantage of that and address the diversification question at the same time.
Sure. I remember we had some clients that worked for GE, and GE was hitting the ball out of the park for many years. But if they happened to retire in 2007 or 2008, and they were all in the GE stock, their retirement just was blown up. So that's important. Don't let the company stock take over the portfolio. Participate, enjoy those benefits, but use a little discretion. So let's move on to number 5, mistake number 5, and that's failing to properly name your beneficiaries. And I know this can be a problem that people kind of take lightly, but it can blow up in their face.
Yeah, I mean it can be, and we're really big on in our firm to doing beneficiary reviews. Life gets complicated. People get married. People get divorced. People have kids, second marriages, the whole deal, grandchildren, and this stuff needs to be reviewed because the beneficiary reviews or the beneficiary designations that you did maybe 10 years ago might not be valid today. It really needs to be reviewed. I mean, we're constantly changing beneficiaries on clients' accounts, and it's really simple to do on your 401k account or your IRA account. There are named beneficiaries. And another sort of subset of this mistake is that people think that because their will has their IRA, their beneficiaries named a certain way, that beneficiary designation will catch every account that they have. And what happens is with an IRA or any other vehicle that has a named beneficiary, that actually bypasses the probate process, which is where you actually execute a will. So just because you have your will beneficiaries set one way, your IRA account is a different vehicle, and you have to name your beneficiaries separately on that.
I know there was a famous case where a woman worked for many years for a school district, and when she went to work there, she just had a sister and her mother as beneficiaries. Along the way, she got married. Along the way, her mother passed away, and along the way, her sister stopped talking to her. So years later, she dies. There was over $1 million. Never mentioned the new husband that she'd married some 20 years back, and the sister, who she never spoke to, got all the money. And that's kind of not what you want to happen. And it's really a simple process to do that. And if you need any help with it, we'll be glad to talk to you about it. So now we come to mistake number 6, and that's trying to win back your losses, or in many cases, chasing performance. These are kind of really two different mistakes that people make, but they can really hurt you.
Well, Barry, it's really about managing your emotions. The stock market's going to go up and it's going to go down. It has since the beginning of time. And it really is human nature to get emotional. I mean,
we all are.
We all are. I mean, it's just, people just get emotional. Just last week I got a call from a client who's like ready to pull all their money out of the stock market because they're concerned about future events, what have you. But you really need to think long term. If you find yourself reacting to markets ups and downs, we'll be happy to sit down with you in your situation. It really comes down to coming up with a proper risk profile and a proper risk tolerance, and really, taking a long view. But you really chasing performance is kind of a losing proposition. And really, what chasing performance is it's kind of like you look at the performance of stocks or mutual funds, and you see, oh, well, this stock did really well last year, so I'm going to put my money in that stock this year, or this fund this year. Well, it may have already, run through its useful life, if you will, and now the next year it's not going to do as well. There's another asset. Maybe there's another asset, particularly with mutual funds.
Mm-hmm.
You chase these. We call it chasing performance. Again, that's an emotional an issue.
To use a football analogy, it's like you see a guy who's wide open. If you throw the ball right to him, chances are someone else is going to come along and knock it away or even intercept it. But if you throw the ball to where he's going to be, well, then you got a much better chance of completion. Now, we don't know where the stock is going to be or where the mutual fund might be, but by using a diversified approach and a sensible approach, you try to hit the singles and doubles, and remember that if you're looking at last year's performance, that's exactly what it was. It was last year's performance, different set of circumstances, and
well,
the
other sports analogy, if you look at past performance of a sports team, maybe a baseball team or a football team, and say, oh, well, the Yankees have done really well over the last 100 years. I think they're going to, that's be a good option to pick them this year. Well, they're playing with a very different team. It's, they don't have Babe Ruth in the lineup anymore.
What happened to him?
And, they don't have Babe Ruth.
You don't read the paper one day and everything just gets right by you. Hey, we should come up with some different analogies, because we probably lost the female half of our audience using all these sports analogies. Maybe in the future we'll try to come up with maybe some gardening or cooking or baking type of analogies for those who are not sports people. Anyway, moving along, let's get to talk about mistake number 7, which is basically hiding your head in the sand and not dealing. I can't deal with it.
Well, hiding your head in the sand is kind of the opposite problem to the last one we did, where you're chasing returns. This one is, you're completely ignoring everything. If you're within 10 years of retirement, it's time to start planning for, what we commonly refer to as the second half of the game. Here we go with another sports analogy.
Yeah, we can't get away from it.
But everybody, I think everybody can relate to the second. You manage the second half of the game differently than the first half of the game, and that is that, I guess you like to use the mountain climbing analogy. So it's like you're climbing up Mount Everest during your working years, and then in your retirement, it's like climbing down the mountain. And it's a different approach. And hiding your head in the sand, you just say, oh, well, I'm just, this fund that I'm in has worked for me for the last 30 years. I'm just gonna stick with it. Well, if you retire and it's like 2007 all over again, it's not going to be very pretty, because you're gonna be managing a 401k account that's going to have a lot of risk in there that you don't necessarily want to have. So,
all right. So you want to deal with this, and happily, if you want to talk to us about it, whether it's your 401k, IRA, or any other financial question, we're more than happy to talk to you. Just give us a call or shoot us an email. We'll quickly touch on mistake number 8, which is forgetting about a loan. And I can understand, because when someone loans me money, I wouldn't mind forgetting about it. But the problem is, it causes all kinds of problems in your 401k.
Yeah, you really want to avoid using your 401k as an ATM machine. If you borrow money from your employer, when you leave, that loan actually has to be paid back, or you're stuck. And then if you're under the age of 59 and a half, I mean, it's a real problem. So
Well, what happens if you've got a 401k and there's a loan against it, and you lose your job, or the company goes out of business? It's not a good idea. You use every other source you can first before you use risk your 401k that way, and that really comes down to I guess to summarize everything we've talked about. You really don't want to go alone with this. The world of 401ks and IRAs, Roth IRAs, all the different ways to accumulate wealth and create income in retirement, it's not something that we're born with the innate ability to handle. And Jeff, you and I have been doing this, each of us, separately, probably 25 years or more, but together as Informed Family Financial Services, we're in our 16th year now. So we do this on a daily basis. And so if you have any questions about your 401k, retirement planning, financial planning of any sort, we're here to be of service to folks. And we've met some wonderful people through the TV show. We'd love to hear from you, whether it's a comment, a criticism, or you have a question. We'd love to hear from you.
yeah, I mean, the good news is we'll be happy to talk to anybody who has a 401k or an IRA or a 403b. The information's right up there on our screen. Give me a call, or you can send me an email too. We'd love to hear from you. Share some of the things that we've learned and how you can avoid some of these mistakes that can be so costly. So again, if you want some information, we actually have a report which we refer to as a white paper, which if you want information on that, just again give us a call and we'd be happy to get that to you. So I guess that wraps things up. You've been watching Financially Speaking with Jeff Bush, and we'll see you again soon.